Hello and welcome to our market alert video for today, which is January 6th, Friday, 2023. And I want to recap with you a little bit of what we talked about last week, because the first part of last week's conversation is very much in the news today. And of course, as you may have noticed, the market is up quite a bit today, given the data we got on labor and jobs and wages. So we're going to dive into that. I got to tell you first, before we do, give you an update on my grandson's walking capabilities. He's got it figured out. And not only that, but he's decided he's going to chase our dog all over the room now. And our dog is 70 pounds and about a foot taller than him. So it's pretty comical. Noodle is a very gentle giant, though. She loves little people and little dogs. And so she goes up and licks him in the face and then runs away and comes back and licks him again and runs away, and he chases after her. And it's a very comical thing to watch. I probably should post a video of it for you guys, but not a financial thing. So let's stick to the what we're supposed to be doing. So this morning, as you may have noticed, the data came in on wages. And the important thing about that is that the hope is that wages will come down without the Fed having to cause mass unemployment. And if that happens, then we will have what everybody's hoping for, which is a soft landing. And so that data came in and kind of put us in the trajectory, if you will, of a potential soft landing. We've seen now for the last several months that wage growth has gone down, but we have not seen unemployment go up significantly. And so that's the happy scenario where wages come down, therefore inflation comes down, but we don't have a lot of people who are now being laid off and unemployed. Time will tell, of course. We just heard Amazon is about to give the biggest layoffs ever in their history. Apple, other companies are talking about it. The companies on Wall Street are all laying off people as well. Not all, but mostly are laying off people as well. So we haven't seen the full flower of this recession or of the effect of the interest rates that the Fed has, the increases in interest rates that the Fed has laid upon us over the last several months. So just to recap last week's video, we talked about 5 drivers that could either drive the market into a new bull market or could drive it down into a worse bear market than we are already in. And of course, the first one is what I've just been talking about, which is inflation. And the optimists are thinking that by the second half of this year, inflation will be down to where the Fed might actually start lowering interest rates. We'll see if that happens, but the data that we got this morning seems to indicate that that is potentially something that could happen. That's why we saw the big rally in the market, or are seeing that today. The other things that we talked about last week, of course, are China and whether or not they're going to get their act together with regard to their economy being shut down with COVID. If they can get that under control and open up the supply lines, that would be a significant reduction in the inflationary pressures, because we buy a lot of stuff from China with their cheap labor. And right now supplies are tight, and that makes prices high. So the combination of that would also help the Fed achieve their goal of a soft landing if inflation comes down without massive unemployment and terrible loss of profits. The other thing is the war in Ukraine. And we heard from President Putin that he wants a ceasefire for religious reasons. The Biden administration says that that's not the case. He's just trying to buy time, let the winter pass as much as possible so that he can renew his invasion of Ukraine. Obviously, if the war in Ukraine comes under control, stops, then food prices should come down, because grain exports out of Ukraine would go back to hopefully some semblance of the past. And plus, potentially, Russia would start getting oil and gas to Europe, and that would alleviate their concerns. So we'll see where that one goes. Putin is sounding like maybe he wants to find an answer, but whether he will or not is the question we don't know. The other thing, of course, is COVID. It seems like everybody I know has gotten COVID again. It's crazy. It's like, or something, coughs and some version of the flu or COVID seems to be resurging, but hopefully that will come under control. So right now, we still feel that the downside risk of all of those things being taken care of is less. The downside risk is more, rather, than the upside potential that all these things will resolve themselves and we'll have a happy ending this year. So for now, we continue to be cautious. We stay in cash, meaning the money market fund. Right now, money market funds are paying close to 4%. That's not a bad interest rate to be getting. In February, the Fed will most likely raise interest rates again, which could put us into the middle 4s%. And if we're safe away from the storm while we're doing that, that's okay with us. So currently, that's our recommendation to our clients. If you're over 50, if you are within 5 years of retirement, or you are already retired, I would encourage you to visit with one of our retirement planners. Help us. We'll help you to build what we call a retirement cash flow plan, which means we'll look at your sources of income, your expenses. We'll help you make decisions on Social Security, your income taxes, your estate planning, your insurance, all those kind of things, part and parcel of a properly designed retirement plan. And hopefully we can help facilitate your second childhood without parental supervision, which is what we call your retirement. But for right now, we think better safe than sorry is the order of the day. So we are not investing, despite the fact that the market was so up today. So thank you for watching this video. Share it with as many of your friends and associates as you want. We want to help as many people as we can achieve that second childhood without parental supervision. So thanks for watching this video, and we will talk soon.